As of 10:10 a.m. Eastern Time on November 4th, 2025, Uber Technologies, ticker UBE, is trading at $93.34 per share. This is a significant intraday move, reflecting a sharp drop of $6.45, or nearly 6.5% on the day. The stock opened at $91.97 and has been volatile, trading in a range between $90.08 and $93.56 on what is already heavy volume of over 13 million shares. Now, the immediate expectation when you see a stock that has had a phenomenal run, up significantly over the past year, tumble 6.5% in the first hour of trading, is that something must be terribly wrong. The common belief is that the company must have reported a catastrophic earnings miss, a complete failure of its business model. But here is the reality, and it's a perfect example of how the market operates. Uber just reported record-breaking results for its third quarter. Trips grew 22% year over year. Gross bookings exploded by 21% to nearly $50 billion. Revenue was up 20%. They posted a staggering net income of $6.6 billion and record adjusted profitability. By almost every headline metric, the company hit it out of the park. And yet, the stock is plummeting. This is the disconnect that creates opportunity for some and panic for others. The reality is not in the headline numbers, it's buried in the guidance. Despite beating expectations for the quarter that just ended, Uber's forecast for the upcoming fourth quarter, specifically its adjusted EBITDA, came in just shy of Wall Street's consensus. The midpoint of their new range is about $2.46 billion, while analysts were looking for $2.49 billion. A fractional miss, but at these valuation levels, perfection was demanded. Furthermore, a miss on operating income, which the company attributed to undisclosed legal and regulatory matters, has introduced a sudden cloud of uncertainty. This is the kind of day where day traders and retail investors using platforms like the Robinhood app or the SoFi active investing platform might be hitting the sell button, reacting to the negative momentum and the red percentage figure on their screen. The high volume we're seeing on the Fidelity mobile app and other investing sites confirms that a major reevaluation is happening in real time. But on the other side, you have institutional desks and long-term portfolio managers, perhaps those using Fidelity Wealth Management or automated systems like Schwab Intelligent Portfolios, looking at this very differently. They are analyzing the 21% growth in gross bookings, the 33% jump in adjusted EBITDA year over year, and the $2.2 billion in free cash flow, and asking themselves if a minor guidance tweak justifies a 6.5% haircut. This is the tension that defines the market. It's a sharp contrast to the narrative around other tech giants. While Nvidia stock has been driven by a clear, forward-looking story on AI, and Apple stock is often valued on its ecosystem stability, Uber is being punished today for a slight deviation in its forward-looking map, even as its current performance accelerates. The trading action is intense. High-frequency traders using sophisticated platforms like interactive brokers are undoubtedly capitalizing on this volatility, playing the spreads and the heavy order flow. For the average person looking at their individual brokerage account, this kind of action can be confusing. The news says record profit, but the stock price says sell. Let's look deeper at the numbers that are causing this rift. The strength in the quarter was undeniable. The core mobility, ride-hailing, saw bookings grow 20% to over $25 billion. This is the mature part of the business, and it is still accelerating. The delivery segment, Uber Eats, was even stronger, with bookings up 25% to $23.3 billion. This segment also saw its adjusted EBITDA margin expand significantly, growing 47%. This is the engine of Uber's growth story. The expectation for a long time was that Uber was just a ride-sharing app. The reality is that it has become a dominant two-pronged platform for moving both people and, increasingly, local commerce. The company is successfully cross-selling its 189 million monthly active consumers from rides to food delivery, and now to advertising. This new high-margin ad business is a key part of the bull case, a high-growth segment layered on top of its existing network. However, the report also exposed the weak link, Uber Freight. In a stark contrast to mobility and delivery, the freight segment's revenue was completely flat year over year, and its bookings actually declined slightly. The segment continues to post an adjusted EBITDA loss. This isn't entirely Uber's fault. The entire logistics and freight market has been in a severe downturn for over a year, with capacity high and rates low. But it does show that this third pillar of the company is not contributing to the growth story right now and is in fact a drag on resources and a weak spot in the narrative. For those who are newer to the stock, what Uber Technologies actually does is operate as a massive global logistics platform. It's built on three main businesses. First is mobility, the iconic ride-hailing service that connects drivers with riders. Second is delivery, primarily known as Uber Eats, which expanded from restaurant food to groceries, alcohol, and other retail goods, recently highlighted by a new partnership with Kroger. The third and most volatile segment is Uber Freight, a digital brokerage that connects shippers with truck carriers, attempting to bring efficiency to the long-haul trucking industry. For years, the story of this company was its staggering growth combined with its equally staggering losses. The primary question for any long-term investment was whether this model could ever be truly profitable on a GAAP basis. The expectation was that it was a cash-burning machine. The reality, which has shifted dramatically in the last 2 years, is that it has found financial discipline. The company is now consistently generating billions in free cash flow, and today's $6.6 billion net income, while massively inflated by a one-time $4.9 billion tax valuation release, shows that the underlying business is capable of producing real profit. This shift from growth at all costs to profitable growth is why the stock has performed so well over the last 18 months, attracting a new class of investors who may prefer using Fidelity mutual funds or Fidelity ETFs that track profitable tech companies, not just speculative ones. This brings us to the future outlook, which is the entire reason for today's sell-off. The tension is clear. Is this a temporary blip or the start of a new, slower growth trend? The bull case rests on several key catalysts. The first is the expansion of advertising. Uber is placing sponsored ads in the Uber Eats apps and ride-hailing, a revenue stream that flows almost directly to the bottom line. Second is the push into automation. Uber has been aggressive in forming partnerships, notably one with NVIDIA, to use their AI architecture for autonomous vehicles. Another deal will see them deploy robotaxis in San Francisco using Lucid Motors SUVs equipped with Neuro self-driving tech. This isn't about replacing all drivers tomorrow, but about creating a hybrid network where autonomous vehicles can handle a portion of trips, drastically lowering the cost. This is the kind of forward thinking that excites investors more than the quarter-to-quarter guidance of a legacy company. And it's a technological race that puts it in the same conversation as Tesla stock. The bear case, however, just got a fresh dose of ammunition. The biggest risk for Uber, aside from competition with Lyft, has always been regulation. The undisclosed legal and regulatory matters that dinged operating income this quarter are a terrifying black box for investors. This could be anything from new driver classification rules in Europe to city-level caps on ride-hailing in New York. Comment below what you think the biggest regulatory risk for Uber is right now, driver classification or city-level ride caps. This regulatory overhang is a constant threat and a key reason why some investors prefer the relative safety of an S&P 500 index in their Fidelity IRAs over picking individual stocks like Uber. And now we have the new risk, a slowing growth trajectory, as hinted at the Q4 guidance, coupled with a weak freight market that shows no signs of turning around soon. So, as we watch the stock try to find a floor after this morning's sharp decline, the picture becomes clearer. The expectation, set by the company's own stellar performance, was for flawless execution and accelerating growth into perpetuity. The reality delivered today was one of almost perfect execution. The core business is firing on all cylinders, growing at a scale that is truly massive. But the market, in its quest for perfection, has seized on a slightly soft forecast and a new legal uncertainty to shave billions off the company's valuation. This is a classic conflict between a long-term business trajectory